A lot of the big names on YouTube talk about how they got started in their financial journey by owning real estate or investing in real estate. For a lot of people, that's not really an option because they don't have a bunch of money sitting around. They might not have the education, or their market is just too hot for it to even be possible to get started in actually owning a property. In today's video, we're going to be looking at another option you might take to get into the real estate market. Today's video, we're going to be looking at O, or Realty Income, which is a real estate investment trust, or a REIT. REITs are special types of stocks that have special rules associated to them. They must invest at least 75% of their money in income earning properties, and they also must pay out a minimum of 90% of their taxable income as dividends to the people who own the stocks. So basically, by owning REITs, you own little portions of a bunch of different properties that are all generating rental income. It's one of two REITs on the S&P's High Yield Dividend Aristocrat Index with an A- ranking or better. So basically, to get onto this S&P High Yield Dividend list, you have to be a company that pays a certain dividend yield over, consecutively over a really long time. And O is one of two stocks on this list. If you want to learn more about dividends and what dividend payout ratios are and why dividends are cool, check out my other video here, which I'll be making shortly. I mentioned earlier that O is a really big company. They have more than 5,000 properties, and they're operating in 49 states and Puerto Rico, and now in the UK as well. Most of their tenants are commercial. Most of them are single renter properties, meaning it's one building with one tenant in it, as opposed to having one building with a lot of different tenants in it. And a lot of the tenants are actually really well-known companies that you've probably heard about before. In recent months, occupancy has been over 98%, despite the global health crisis. And they've really focused on building partnerships with companies that aren't susceptible to e-commerce changes and probably will do pretty well during health crises like we have now. Check it out. 12% of the portfolio are convenience stores, 10% are drugstores, 7% are dollar stores, 7% are health and fitness clubs, 6% are fast food, and 18% are non-retail. Non-retail can mean agriculture or office space or things like that. Check it out. Realty Income has put up a couple of really big encouraging numbers at the top of their investor relations page, which I'll put up now. They have 15.3% compound average annual total return since 1994. And a 4.5% compound average annual dividend growth since 1994. That means their dividend is growing 4% annually. 601 consecutive monthly dividends paid. So that means 601 months in a row they've paid dividends. They don't fail to pay dividends. And in fact, it's part of their name. They say, we're the dividend company. They call themselves the monthly dividend company because that's one of the things that got them famous. They pay you out every single month a dividend. And actually, this company's so popular and so well known that it's become kind of like the backbone of a lot of dividend investors' portfolios. I own O, and I've owned it for a very long time. But one of the things I've been thinking about kind of in these past, 6 or 8 months is kind of what's gonna happen if are people just gonna stop paying rent? Are they gonna get jacked because people are moving out? Or because certain states are requiring them to not collect rent from their tenants? What happens to the company in that case? And sure enough, check out the price charts we see here. In March, we saw a huge dip. It went down almost half. Since then, it's recovered nicely. And as I'll mention here in a minute, the growth is still doing okay, but it hasn't reached up to those highs that we saw before March, and therefore is probably a pretty decent buying opportunity now. I'll get into some of the numbers going forward here, and then at the end, I'll share about my own personal steps going forward, if I'm gonna add to my position or if I'm gonna think about getting out of it or what. So Realty Income is constantly buying new properties and then building partnerships with people who come in and rent from them. They also do portfolio management, real estate research, credit research, asset management, all these different kinds of things. But basically, the outline of their business is that they buy properties to rent out to other people. Two of the really big characteristics of the way O operates are one, typically 15-year lease terms, and then two, triple net lease. Check it out on the screen here. Triple net lease, as defined by Wikipedia, is a lease agreement on a property whereby the tenant or lessee promises to pay all the expenses of the property, including real estate taxes, building insurance, and maintenance. So typically, if you've ever rented an apartment, you'll know that you pay rent and that's it. You might have insurance if you choose to get it, but the owner of the building will pay insurance on the actual building in case a fire burns the whole thing down. That insurance doesn't cover your stuff in the room. You would need to get your own renter's policy to cover your own stuff in the room. So triple net lease basically says, hey, we'll charge you a lower rent, but you're responsible for maintaining it. We're not gonna come fix your toilets. You're responsible for paying the taxes on it, and you're responsible for paying insurance. So one of the really cool things about that is that you get really satisfied people who probably are gonna be, saving a little bit for a 15-year term. And so as a REIT, you can say, hey guys, we got a new guy who's coming in for 15 more years who's gonna be making you money every single month. And that's neat for the investors. But one of the tricky things about it is that they can't really raise rent rates like you typically could against tenants in other situations. So for example, if you've rented an apartment or you've rented commercial space before, if it's like a 3-year lease or a 5-year lease, a lot of times when that lease finishes, they'll say, okay, because of inflation, next time we have to raise your rent price by like 5% or 8% or things like that. But because it's a 15-year lease, basically they're limited to only doing 1% per year, which actually doesn't even keep up with inflation in most cases. So it's a bit of a double-edged sword because you get happy tenants who are invested for the long term, but at the same time, the margin is going to be shrinking as you go. I'll get into how that affects the bigger picture and also some other downsides towards the end of the video. I wanted to get into some highlights for the quarter ending June 30th, which was just a little while ago, that they just reported on. Net income per share was 31 cents. Adjusted funds from operations increased 4.9% to 86 cents. They were able to collect 86.5% of their contractual rent obligations across the total portfolio. So that was addressing one of my concerns I mentioned earlier, like during this time whenever retail in general seems to not be doing too well, O is coming around and saying, don't worry, we were still able to collect more than 86% of the rent that we're owed. They invested $154 million in 32 new properties, including $58 million in the UK. They also raised $593 million through unsecured notes and raised almost $100 million from the sale of common stock. So when they're raising money like this, it basically says, hey world, we need more money, so we're gonna invent some new stock and sell it, so they get a bunch more cash. They use that money to turn around, buy more properties, which they can then lease out and make more money. The tricky side to raising capital by selling more stock is that, remember the Apple stock split video that I talked about before? Imagine the whole company as a pie and it's split up between all the shareholders. Now, you're basically taking the existing slices and making them a little bit smaller, because the whole value of the company doesn't change. Just the number of stocks, it does change. So every stock becomes more diluted or less heavy, or just different ways you can look at it. So 100 million isn't like a huge number to be scared about or anything like that. Some more figures for us to look at from the last quarter. Revenues increased 15% to 829 million. 15% is pretty good for this climate. Net income increased 24% to 254 million. Funds from operations per share increased 2%. And dividend per share increased from 135 to 139. That dividend per share of 139 isn't per month, it's per year. So divide that by 12 to get your monthly income if you own one stock. An update on the rent collection. At the end of July, they were saying that they had collected 91.5% of contractual obligations. So that's a good sign. The amount of rent they're being owed is becoming less and less. So that's a good sign. Should also mention that the retail portion of their portfolio is getting smaller as they boost other portions of their portfolio. So I just mentioned a minute ago that they acquired about $150 million of new properties in the last quarter, but typically they do about 500 million. So they're nowhere near that. And I'll get into why that's a warning sign for the future at the end of the video. Compared to a lot of the other stocks I've been looking at recently with PE ratios through the roof, like mind-boggling numbers, Realty Income's PE ratio is only 44. So it's kind of like, wow, are we in, is this okay? Is this scary? Is this risky? Have people forgotten about this company? And I think that's kind of the nature of, number one, how insane tech stocks are right now, but also number two, REITs in general are typically like this, and I think it's not a bonkers price at all. It's like a pretty fair price right now. So check it out here, looking at the 1 year chart, we see that huge dip in March and kind of like struggling to get back up there. We see the price fluctuating a lot more than it did before March, and I think a lot of that has to do with the way people are anxious about the future, especially as it relates to interest rate changes. The Fed's movements, the Fed's selections on how to control interest rates, and probably how that impacts the election or vice versa, has a lot of play in real estate and therefore in REITs. That being said, I also wanted to mention their price to sales ratio, which is 13.85, which is like a pretty delightful number if you're thinking about investing in a company, especially when we're used to all these crazy tech companies. So going in a little bit to some of the concerns I have about the future of Realty Income. Number one, as I mentioned earlier, the whole triple net lease concept is a bit of a double-edged sword. It's cool because you can get people in who say, 15 years I'll be here, and they seem to be really good at getting companies that don't, take off in the middle of their lease and are able to pay rent regularly, and almost all of them are paying it on time, and therefore you as a stockholder get your dividend every month. But the downside to that, the other side of the blade, is that you can only raise rents 1% per year, which doesn't keep up with inflation, and it also makes it trickier to figure out other ways to make a good margin. And that therefore pushes Realty Income into a situation where they're kind of like needing to always be acquiring new properties. And if they stop acquiring new properties and finding good deals, then they can't grow and they can't make more dividend income because they're not making a lot of margin on their rents, especially as the lease gets older and older and inflation chips away at their margin. Typically with property management companies, the property management company needs to handle all the things that triple net lease doesn't, like fixing the property, or in some cases even helping tenants set up the property in the first place, which can be a very specialized and technical process. Additionally, repairs and maintenance and staying in touch and things like that. All of those things are quite highly skilled prospects. But because Realty Income operates without those things, they put those all in the tenant's hands. Therefore, the barrier to entry to be a competitor against Realty Income is much lower. Realty Income isn't coming and saying, we have all these special skills, so you're gonna be paying us a premium for that. On the opposite, they're saying, you take all of the burden, we're just gonna find more properties and then, sell them when the time is right. So that gives them almost no moat, almost no protection from other people coming in. And right now, what's happening with the Fed is that they're lowering interest rates. So it makes it really easy to go to the bank and say, hey, Mr. Banker, I have $1 million. I want to buy a property for $10 million. Help me out. And they're like, yes, please. Take our money and do anything with it rather than doing nothing with it like we are. And so with really low interest rates brings a lot of people trying to buy and trying to finance properties, which in turn increases competition against O. And as competition increases, what's going to be really tricky to see in the coming kind of probably years, as that interest rate is kind of pushed back up to a more normal, more healthy level, that's basically O's margin getting thinner and thinner and thinner. So unless they're really aggressive and really good at staying on top of finding really dope properties and renting them out to really dope companies that aren't going to be high risk, then that dividend is going to just be getting smaller and smaller. And another concern is that typically these properties that they're working with aren't really highly specialized. They're generally just kind of like empty shells that it's kind of like, hey, you can make a drugstore here, do it. And then the tenant comes in and decks it out how they want to. So they're not very special places in a lot of situations, and therefore makes their moat even more non-existent and makes them more susceptible to competition going into the future. And I think as we're going forward in the future here, you look around on YouTube and there's like thousands of people offering real estate courses, how to get started in real estate, make big money in real estate, stuff like that. I think, kind of going 5 or 10 years into the future, that will trickle into commercial real estate and large retail and things like that. All those things to say, I think Realty Income isn't the perfect company, and it isn't like invincible. It's not one of these companies, you know, like Visa or Walmart or Apple that are just kind of like, you know, we're going to be rock solid for like many years. But as a result, you know, P ratios are low, people are a little bit skeptical, and therefore the price hasn't gone bonkers either. So currently, our stock price is just under 65. I feel like that's not a bad price for what you're getting. REITs don't grow in price that much. Mostly what you're getting is that dividend payout, and their dividend payout ratio is 4.35% currently, which is pretty delicious. When you're thinking about like, dude, I want to diversify, I want to get into real estate and things like that, you know, maybe you're too tech heavy, or maybe you're just all of your investments are just too focused on one little niche, it's smart to get into real estate. But one of the calculations you have to do, like for one of our rental properties, we had to put down like $50,000. And so if you had that same 50K, you know, you can figure out a way to make a rental property. You're gonna have to manage it, you're gonna have to be involved, you're gonna have to fill it up, and you can get some reward. If you took that same 50K and put it all in Realty Income, you'd be making only about $2,100 a year in dividend income. Granted, you don't have to do anything. You basically just sit there and get paid. $2,100 isn't like an amazing return on income, but you know, if you reinvest the dividends and you're constantly kind of putting in a little by little, after 10, 20, 30 years, that could be like a really significant income for you. So I think a lot of people don't really have the means to go out and buy a property. They don't really have the skills or talent or motivation to be managing it, to be repairing it, to be filling it up with tenants and screening them and property management, all that stuff. So if you're like, dude, I want to get into real estate, I want to have a little bit more balanced of a portfolio, this is one way that you can kind of get into that. And O has been a really reliable, a really trustworthy company, and their management is top notch. So what am I going to be doing with O? I mentioned that I already have some Realty Income stock. I've been holding it for a few years now, and I've enjoyed it. I didn't enjoy the dip in March, and I haven't actually looked into it much just because everything else has been so crazy in the stock market recently. But now that I've looked into it and saw that it's like at a pretty fair value, you know, I might pick some up, and it might be one of those stocks that I just add to my, you know, regular quarterly checklist where I'm just kind of adding a little bit. Unless the price goes bonkers again, then I'll kind of hold off on that. But typically speaking, REITs aren't going to have that crazy price appreciation like you see, especially with tech stocks right now. Let me know what your thoughts are. Thank you guys very much for your time, for looking into this. I know there are a lot of YouTube channels available right now, and you've chosen to watch this whole video. I thank you guys so much for that. So please take a moment to hit the like button. If you're not a subscriber yet, please sub. Let me know what your thoughts are. Let me know what you're going to be doing with O. If you're going to be adding to your position, if you're going to be buying for the first time, or if you're going to be selling. What do you think is on the horizon with this tricky economic situation that we're in right now? Thank you guys very much. Love you and have a great day.